Welcome back to the Pro Ticker Podcast, your Tuesday morning edition covering major financial magazine headlines, everyone. Today's deep dive is absolutely critical because the sources we pulled, from CNBC, Yahoo Finance, and Bloomberg, they're really showing a market that seems fundamentally split.
It really is. A perfect dichotomy, you could say. You've got this massive upward force, right, driven by AI, incredible corporate growth, keeps pushing valuations maybe higher than they should be.
Into the stratosphere, yeah.
But then opposing that is the, let's call it, hard reality. The valuation warnings, geopolitical risks. It's like a constant reminder that, well, gravity still applies to markets.
Exactly. So our mission today is to really try and extract the core insights from that conflict. We need to help you navigate this intense debate. Is it irrational exuberance, like some are saying?
Or is it just, the fair pricing of real revenues, as the optimists insist?
Let's unpack this. I think we should start where that valuation tension is maybe most visible right now.
Yeah.
The AI engine room.
Makes sense. And we have to start with Palantir, ticker PLTR. They just reported Q3 results. According to CNBC and Bloomberg, they delivered a very strong beat. Adjusted EPS came in at 21 cents versus, 17 cents expected.
Right, and revenue.
Revenue was $1.18 billion. That easily topped the $1.09 billion forecast. And they also gave pretty strong guidance for Q4.
Okay, so on paper, that sounds like a dream report, doesn't it? Strong beat, strong guidance, massive underlying growth. You mentioned total revenue jumped 63% and U.S. government sales up 52%.
Yeah, huge jumps.
So I'm genuinely puzzled here. If you beat that strongly and your core government business is booming, why did the stock drop? Yahoo Finance reported it fell between 4% and 7% in after hours and pre-market. Is that purely valuation, or is something else hiding there?
No, it seems it's purely the valuation argument hitting wall. Analysts have cited the lofty valuation, calling it unprecedented levels.
Yeah.
The metric that really stood out, and Bloomberg highlighted this, is PLTR's price-to-sales ratio. It's sitting at 85.
85.
85. That is the highest in the entire S&P 500. And its forward PE ratio is somewhere near 280.
Wow. But okay, hang on. If their revenue is truly jumping 63% year over year, like you just said, doesn't a super high PS ratio naturally shrink much faster? Couldn't that maybe justify the current price? Or is the market just saying even 63% growth isn't fast enough for an 85 multiple?
It seems to be the latter. The consensus is that there's simply too much baked in already. You're priced not just for perfection, but for absolute market domination that hasn't fully materialized yet. And look, Palantir's CEO Alex Karp, he's clearly defiant about this scrutiny. Sources quoted his comments from the earnings call. He took a very aggressive, unapologetic stance against the critics. He actually told them, enjoy, get some popcorn, they're crying.
He actually said that.
Apparently so. And he also tied the company's mission directly to U.S. national security interests, referencing support for ICE in Israel, discussing fentanyl, which, further complicates the investment thesis for some.
Yeah, that adds another layer entirely. That whole saga, though, it perfectly illustrates the market psychology right now, doesn't it? Let's broaden out then. The wider AI investment frenzy. Is this a bubble, or are these valuations justified by what's actually happening?
Well, look, we have compelling evidence for both sides, really. The pro-growth view, you see it championed by people like VC founder Magnus Grimeland in CNBC interviews. His point is that AI is fundamentally different from the dot-com boom because it has real revenues.
Real revenues now. Okay, like what?
He pointed out OpenAI reaching $10 billion in annual recurring revenue. Another company, Lovable, hit $100 million ARR in just 8 months. And the adoption is immediate. It's rapid. Businesses, consumers. He even mentioned how his own personal search habits completely changed in less than a year because of AI tools.
Okay, that's a strong case for real. But the skepticism, it hinges on this capital expenditure mismatch, right? Which seems massive.
It is massive. And you had the General Atlantic CEO, William Ford, and HSBC CEO, George Elhedery, both warning about this imbalance. Ford specifically warned about misallocation of capital and short-term irrational exuberance.
Misallocation of capital, that's a big warning.
And this is where you just have to pause and absorb the sheer scale of money we're talking about. Big tech firms, collectively, they expect about $380 billion in CapEx this year.
Okay,
Yeah.
$380 billion.
But in contrast, OpenAI alone has announced deals that imply, roughly, $1 trillion worth of future infrastructure spending with its partners.
$1 trillion, compared to $380 billion for all of big tech this year.
Exactly. That enormous gap suggests that the expected payoff, the productivity gains, the revenue benefits, that's a long-term play, like 5 to 10 years out. But we're currently paying up front today for an opportunity that might be decades away from fully monetizing.
That is a staggering gap. Wow. And speaking of infrastructure and deals, CNBC reported Amazon signed a huge deal, $38 billion, with OpenAI for AWS access.
Yeah, that's significant. It signals OpenAI is actively diversifying away from just relying on Microsoft.
Which suggests they're maturing operationally, maybe getting ready for a potential public offering down the line.
Could be. It definitely strengthens their position. And this whole infrastructure battle, it's just fueling the chip companies, isn't it? AMD reports Q3 today. Yahoo Finance noted analysts expect EPS of $1.17 on about $8.7 billion in revenue.
Okay.
But critically, those massive new deals they announced with Oracle, with OpenAI, the Dewey supercomputers, those won't impact these Q3 results. It's all about the future pipeline, especially those MI450 GPUs launching in, 2026?
Right, future growth focus. And of course, you can't talk chips without mentioning NVIDIA. Market cap recently crossed $5 trillion. But there's a political complication here too, isn't there? According to Yahoo Finance, President Trump asserted that the most advanced NVIDIA Blackwell chips will be reserved for U.S. customers only.
That's right. And that introduces a significant geopolitical layer right into the heart of this AI arms race.
Yeah.
Who gets the best chips?
Which takes us neatly, as you said, into Wall Street's reality check. Because for all the excitement about future growth and these massive deals, the big architects of the market, they're sounding caution alarms today.
They certainly are. It's pretty striking. CNBC and Bloomberg both reported a kind of consensus warning from top Wall Street leaders. We're talking Goldman Sachs CEO David Solomon, Morgan Stanley CEO Ted Pick, Capital Group's Mike Gitlin.
All the heavy hitters.
Exactly. And they all basically advise investors to prepare for a 10% to 20% equity market drawdown sometime in the next 12 to 24 months.
10 to 20%.
Yeah.
Okay. And the rationale is just valuations.
Pretty straightforward. Valuations are full. The S&P 500 is trading around 23 times forward earnings estimates. That's well above its 5-year average, which is closer to 20 times. And the NASDAQ 100 is even loftier, about 28 times.
Right. But they weren't saying sell everything, were they?
No, not at all. Actually, the positive takeaway, if you can call it that, is that these CEOs seem to view potential pullbacks as a healthy development, something that allows for reassessment. They were advising clients to stay invested, rather than trying to time the market perfectly.
Okay. Stay invested, but brace for turbulence. Makes sense. Now, within the financial sector itself, Bank of America seems to be trying to solve its own valuation problem this week. Yahoo Finance detailed that CEO Brian Moynihan's team is launching its biggest investor pitch since, 2011 to justify a higher valuation. The stock's really lagged its rivals, hasn't it? Despite BofA being enormous $3.4 trillion in assets, 70 million customers.
Yeah, it's a bit of an underperformer relative to peers like JP Morgan, especially over 5 years. And the core issue, as critics point out, seems to stem from their strategy after the financial crisis. The suggestion is BofA maybe leaned in too far to the responsible part of its growth strategy.
Responsible part. What does that mean in practice?
Well, specifically during the pandemic when deposits surged everywhere, they apparently plowed hundreds of billions of dollars of that excess cash into lower-yielding, long-dated securities.
Yeah.
Like treasuries and mortgage-backed securities.
So they effectively bet on interest rates staying low for longer.
Seems like it. And when the Fed started hiking rates aggressively, they got caught.
They were stuck earning pennies on that huge pile of cash, while rivals like JP Morgan, who maybe kept more cash flexible or in shorter-term assets, were suddenly making a fortune as rates rose.
That's a perfect way to put it. They missed out on that big net interest income boost. So now they're under pressure to convince investors they have a clear path to better profitability. They need to present a target for something like return on tangible common equity, or ROTCE.
ROTCE, right.
Yeah, it basically measures how efficiently they're using shareholder capital to generate profit. And rivals like JPM are already hitting around 17%, Wells Fargo maybe 17, 18%.
Yeah.
BofA needs to show they can get closer to those levels.
So it's all about demonstrating operational excellence now. Got it. That focus on strategy, though, leads us to something that could be a huge catalyst for the broader economy. M&A, Goldman Sachs CEO David Solomon, he predicted a tremendous backlog of large M&A deals for 2026 and 2027.
Yeah, he said CEOs feel unleashed now, ready to pursue scale again, maybe now that the immediate sort of economic shocks in the past couple of years is passing.
Unleashed. Interesting word choice.
It is. But that forward view on M&A, it contrasts pretty sharply with the near-term macro uncertainty, doesn't it? Because even as CEOs feel ready to do deals, The macro data right now is still, well, heavy, a bit murky.
True. So turning to that broader macro picture, CNBC reports the 10-year Treasury yield fell a bit today by 2 basis points, down to 4.085%. The 2-year yield also fell.
And we had some key comments from the Fed today. Federal Reserve Governor Lisa Cook explained why she sided with the recent rate cut. She basically believes the downside risks to employment right now are greater than the upside risk to inflation.
Okay, that's a dovish tilt from her. And we're also expecting Fed Vice Chair Michelle Bowman to speak today, right? We'll have to watch for that.
Definitely. But assessing the economy overall is still really difficult because of the persistent U.S. government shutdown. As CNBC noted, it's delaying the release of critical data.
Well,
You still don't have the October jobs report, no JOLTS data.
it makes the Fed's job even harder trying to navigate without the usual dashboard.
Exactly. And adding to the concern, the ISM Manufacturing Index also missed expectations. Came in at 48.7% versus the 49.3% forecast. So below 50 is contraction territory. It's just a hazy economic picture right now.
Hazy indeed. Let's shift gears a bit now to the geopolitical and crypto crossover. That's been adding to market instability too. Yesterday, Ether fell about 7%. Why? Because the Ethereum-based Balancer DeFi protocol suffered a multi-million-dollar hack. CNBC reported on that.
Right, another DeFi hack. It just creates fresh waves of instability in the digital asset space. Confidence takes a hit.
And then there's the ongoing political drama involving Binance. The new CEO, Richard Tang, he denied accusations that Binance gave preferential treatment to a Trump-linked stablecoin called USD1.
Yeah, this was reported by both CNBC and Yahoo Finance. The accusation relates to the period before the pardon of the previous CEO, CZ. This stablecoin, USD1, it was created by a firm called World Liberty Financial and apparently used in a $2 billion investment deal with another entity, MGX.
Okay, so a lot of moving parts there. And this alleged connection, it's drawn major political scrutiny, hasn't it? Senator Elizabeth Warren, for instance, has openly voiced corruption accusations related to CZ's pardon and these broader financial ties between the Trump administration and the crypto industry. Just to be clear for you, we're reporting impartially on this content. Trump, for his part, claims he pardoned CZ at the request of very good people, but said he knew nothing about him personally.
Right. It's a complex web of finance, politics, and crypto. Shifting from crypto politics to trade politics, Yahoo Finance gave us details on the recent Trump-Xi meeting truce.
What came out of that?
Well, the U.S. agreed to pause reciprocal tariffs for another year, and China, in return, ended its investigations into U.S. chip companies and is set to resume buying U.S. wheat and soybeans. So, a clear pause in hostilities, at least for now.
A pause, but the underlying threat of tariffs isn't really going away, is it? Treasury Secretary Scott Bessent indicated that even if the Supreme Court rules against the current authority used to enforce tariffs, the IEPA Act, the administration plans to use alternative measures, like Section 122 of the Trade Act of 1974.
Right. So the key takeaway seems clear. The administration intends to keep tariffs in its toolkit one way or another, regardless of how the Supreme Court rules on the current legal framework.
That risk of tariff persistence is just a constant overhang for supply chains, isn't it?
Absolutely. It's something businesses constantly have to factor in. Okay, let's maybe finish up with two key corporate stories that caught our eye. One in energy, one in governance.
Sounds good. Let's start with energy. BP had a very strong showing, apparently. CNBC reported they beat Q3 profit expectations, posted $2.21 billion versus a $2.03 billion consensus estimate. And this was despite weaker oil prices. How?
Mostly driven by higher oil and gas production. They just pump more volume. But what's really crucial here strategically is the pivot they made about 8 months ago. This success follows BP's, quote, fundamental strategic reset. Remember that. They pivoted back to prioritizing their traditional oil and gas business.
Oh, right. They actively slashed spending on renewables.
Exactly. And investors seem to have broadly welcomed this U-turn. BP shares are up over 13% year-to-date. It looks like a clear case of shareholders rewarding a return to, well, profitable fundamentals.
Interesting. A counter-narrative to the ESG push in some ways. Okay, and finally, a major corporate governance battle brewing at Tesla.
Yeah, this is significant. Norway's sovereign wealth fund, the Norges Bank Investment Management, which is huge, like $2 trillion announced it will reject Elon Musk's proposed $1 trillion pay package.
Reject it.
The concerns they cited, according to CNBC, center on its total size, which is obviously enormous. Also, the potential for dilution of existing shareholders and what they called a lack of mitigation of key person risk, tying so much to one individual.
That's a big institutional pushback.
It really is. And it comes as Tesla is also dealing with some operational challenges. Reuters reported their China-made EV sales actually fell 9.9% year over year in October.
Ouch. Falling sales in China is not good news for them.
Not ideal.
Yeah.
And just as a sort of interesting side note, politically, we saw President Trump and Elon Musk both endorsing Andrew Cuomo over the Democratic nominee Zohran Mamdani in the New York City mayoral race this week.
An unusual alliance there.
A bit unexpected, yeah.
Okay, so let's try and tie this all together. What does this all mean for you, the listener, trying to navigate this market? We started the day wrestling with that AI exuberance, Palantir's crazy valuation despite strong numbers. And we kind of finished confirming this central dichotomy, don't we? You've got incredible underlying corporate momentum in some areas, AI adoption, strong sector earnings like BP, a potentially huge M&A backlog coming.
Right, real forward momentum.
But that momentum is just running smack into Wall Street's explicit warning that valuations are simply too full. They're stretched. And the geopolitical picture from chips to tariffs to crypto regulation, it's just creating layers of uncertainty.
Yeah, I think the ultimate illustration of this whole tension lies in corporate strategy and where the capital is actually flowing. Look, the biggest decision for investors right now probably isn't if the market pulls back, because the big banks are warning it likely will. It's where institutional capital is being actively redirected for long-term scale and sustainable returns.
So strategy over hype.
Maybe. The story of Palantir dropping, despite great numbers, shows that market gravity is highly sensitive to expectations, especially stretched ones. While the story of BP getting rewarded for pivoting back to fundamentals shows that clear strategy, not just hype about the future, is what drives sustainable returns, particularly in this kind of volatile environment. That tension, between tomorrow's potential revenue and today's very real valuation, that's the core dilemma facing every institutional investor right now.
An essential tension to keep monitoring indeed. A lot to think about. We'll see you all tomorrow morning with new headlines from major financial magazines.